Unit 4, Risk and Return, Lecture 7, Portfolio Theory Part C. Now I'm going to move on to the Capital Asset Pricing Model, or CAPM as it's known. It is probably one of the most famous market return models. It is the equilibrium model that underlies all modern financial theory. It was derived using principles of diversification with simplified assumptions. And Markowitz, Sharpe, Lintner, and Mossen are researchers credited with its development. There are a number of simplifying assumptions for CAPM. Individual investors are price takers, so they can't influence the prices of shares or securities. They have a very short investment horizon, myopic behavior, and all their investments are limited to the universe of publicly traded financial assets. Investors pay no taxes, and there are no transaction costs on trades. Information is costless and available to all investors. Investors are rational mean variance optimizers. They're assuming they all use the Markowitz portfolio selection model, and they are homogeneous. They have homogeneous expectations. So basically, they all have the same input list to feed into the Markowitz model. Some of these are, as you can see, not all that realistic. When using the capital asset pricing model, it must be noted that the only risk allowed for in the model itself is market risk, sometimes known as systematic risk or undiversifiable risk. So essentially, it is the risk that you cannot get rid of by the way you construct your portfolio, and this is measured in the model by beta. And beta is a measure of how a security's return co-varies with the market returns. The thing to note about betas is they can vary over time because the market is depicted in terms of an index. So an index is used to represent the market. And if that index or its constituents change, this will have an impact on the beta of a share. Beta of the market is always 1. Some other conditions to note regarding CAPM is that all investors will choose to hold the same portfolio of risky assets in proportions that duplicate the market portfolio M. The market portfolio contains all traded securities, and the proportion of each security in M is its market value as a percentage of total market value. Not only will M be on the efficient frontier, but it will also be the tangency portfolio to the capital allocation line. As a result, the capital market line is also the best attainable capital allocation line. And this slide is a depiction of the capital market line along with the efficient frontier. And what's important to note is that the only difference between the capital allocation line and the capital market line is that the risky portfolio is now the market portfolio. In looking at the market risk premium, which is an important component of the capital asset pricing model, the risk premium on individual securities is a function of that security's contribution to the risk of the market portfolio, and it is a function of the covariance of its returns with all the assets that make up the market portfolio. And here we are at actually the start of the show, the CAPM model itself, which is the expected return for an asset or a share is a function of the risk-free rate of return plus beta for the security, so its market risk, times the market risk premium, which is the expected return on the market less the risk-free rate. So looking at a simple example, the risk-free rate and the expected market return are 6% and 12% respectively. So according to the CAPM model, the expected return on the security, if it has a beta of 1.2, will be 13.2%. Essentially, the security market line is a graphical representation of the various risk-return combinations. So the risk here is market risk or beta, and the returns are those returns that are generated by the capital asset pricing model. So securities that lie on the security market line earn exactly the expected return generated by the CAPM, and their prices are proportional to their beta coefficients, and they have no alphas. In looking at the security market line versus the capital market line, it is important to note that though they both depict risk-return relationships, the capital market line focuses on total risk. So it includes both diversifiable and undiversifiable risk, and this is denoted by standard deviation, whereas the security market line is focused only on market risk, and this is denoted by beta. So when we look at CAPM and the security market line, because the returns from CAPM are depicted by the security market line, any deviation from that line has an impact on the stock price and an implication for that stock price. So when the forecasted expected return is higher than the required expected return, or the return generated by the CAPM model, the stock is considered to be undervalued. Obviously, when the forecasted expected return is less than the return generated by the CAPM, the stock is overvalued, and in equilibrium, the expected return and the required return will be the same. So this is just a graph showing when shares or stocks are over or undervalued relative to the security market line. So again, to demonstrate this concept with an example, your opinion is that CSC has an expected return of 10.5%. It has a beta of 1.3. The risk-free rate is 4%, and the market's expected rate of return is 11.5. Is this security, according to the CAPM model, undervalued, overvalued, or fairly priced? Since the return generated by the CAPM model of 13.75% is higher than the expected return of 10.5%, this security is currently overvalued. This slide summarizes briefly the differences between the required rate and the expected returns and the impact it has on the valuation or the implications.